Hello and welcome to another financial analysis video. Today I'm taking a look at Gamestop. This is a video game retailer whose stock I own. And, the company's shares have been under pressure throughout this year. They've recently bounced off of a 52-week low, but are still down 25% from a year ago. However, one thing that may be attractive to income investors is GameStop's dividend, which is now yielding almost 8%, which is pretty unheard of in the stock market right now. So what I want to do is take a closer look at the company, some of its operating metrics, and we'll see if the dividend is sustainable or not. Right now, GameStop's earnings overall, and this is probably a better chart to show here, close to flat, if not slightly negative. However, the most recent quarter showed earnings growth of slightly over 1%. Similar trend over here with revenue, as sales barely growing for the video game retailer. They are, however, meeting or beating expectations. They've done so in 3 out of the last 4 quarters. So it's not as if they're negatively missing analyst expectations. And we'll take a little further look out here in our earnings grid. There has been, and this is the next quarter earnings coming up, Q4, there has been some slippage in analyst expectations. However, for the fourth quarter now, we've seen pretty much a flat expectation amongst analysts over the last 2 quarters. And this is important because when you look at dividend sustainability, you want solid earnings expectations. You want the company to meet or beat those earnings expectations. And then you want those earnings to support the dividend. So if we take a look at the payout ratio on a trailing 12-month basis, you'll see that the earnings are clearly capable of supporting the dividend. Right now, GameStop is paying out 41% of its earnings to shareholders in the form of a dividend. So that is a pretty good, pretty healthy mark for them. I also wanted to add that, going forward in future years, analysts are expecting earnings to decline slightly. Therefore, that payout ratio is going to go up. It should approach 50% in 2019, and so that's something to be cognizant of too. You've got some earnings headwinds here that the company needs to get through. They've recently announced video game rentals, which hopefully will generate some new revenue and improve their profit margin. But last but not least, I wanted to look at free cash flow, and that is this chart right here. Free cash flow is a metric I take very seriously. It is, the company's ability to generate cash after capital expenditures. And this red line in this chart is the dividend projection over the next 12 months, right now at $154 million. This is trailing 12-month free cash flow, and that has fallen to $266 million. It is still strong enough to support the dividend. That is important. However, this decline should allow investors to take note of it and, be very careful. If this continues to slip, there could be a problem. Now, it did slip in one quarter a little over a year ago and then bounced back up, and there was no dividend needed in order to do that. So I'm confident right now that GameStop's dividend is going to hold for at least another couple of quarters. One other chart I want to show before I leave you is this dividend, which is in blue, versus a projected calculation of the dividend, which is in red. And this uses the return on equity and the 1 minus the payout ratio to determine what a projected dividend should look like for an organization. And for GameStop, right now, they're basically right in the average of that projected dividend. And frankly, for a while, they were over that projection, but now right in that. So overall, I think GameStop is a good income play. I think that the free cash flow over the next 2 quarters needs to be watched. But other than that, investors can continue to look for further slippage in forward earnings. And I think, though, that this is, for its return of 8% or the income of 8%, a wise investment play. I hope you enjoyed this video. We'll see you next time.